Your credit score is one of the most important pieces of your financial health that you can manage and have full control of. Over your lifetime, a good credit score can easily save you from tens to hundreds of thousands of dollars. And unfortunately, many people grow up never really understanding how credit works. For that reason, I put together this guide to help give you an understanding of what makes up your credit and how to get started with building it. So let's get into it. So what is a credit score? It's a 3-digit number between 300 and 850 that companies, banks, and lenders use to determine how likely you are to pay back borrowed money. By having a higher credit score, it allows you to get better interest rates from lenders on loans, and it could save you a lot of money over your lifetime. Now, when it comes to credit scoring, there are two companies that dominate this space that lenders look at. That's the FICO score and the Vantage score. They both have a range of 300 being the lowest and 850 being the highest, as well as they both pull the same information from you. But the difference that lies between the two is that they weigh certain factors on your credit report differently. Since 90% of consumer lending is based on FICO scores, it's the most important to look at, and that's what we'll be focusing on in this video when we talk about credit scores. So who dictates what your credit score is? Well, it all comes down to the three credit bureaus, which is Experian, Equifax, and TransUnion. They don't decide if you should receive credit or not, but their role is only to collect and break down your credit activity in a credit report. And all that information is used to create your credit score. And the credit reporting process goes something like this. So if you've used a credit card, have taken out a loan for a car or a home, chances are you have a credit report with each one of the reporting agencies. Now, whether or not you've been responsible with your payments or managing your credit, once every 30 days, these credit activities are reported from your creditors to the three reporting agencies separately. The agencies collect this information they receive from the creditors and lenders and create a credit report. Remember, each bureau manages this information separately, so you'll have one credit report from each agency and 3 reports in total. Then the information in the reports are used to calculate your credit score, which lenders will decide whether they want to extend credit to you and at what rate. Next, what makes up your credit score? How your FICO score is calculated can be broken down into 5 different categories. While some have bigger impact than others, they're all important in determining your score. This includes payment history, which is your on-time payments, and that makes up 35% of your score. Amount owed is 30%, which is the amount of credit you're using out of your total available credit. New credit is how much of your credit portfolio is considered new. Credit mix is the variety of credit that you have. And last is your length of credit. So now that you've gotten a brief idea of the pieces that make up your credit score, let's jump into the details of each to see what that really means. The first factor that makes up your credit score is your credit mix. Credit mix makes up 10% of your credit score, and it's referring to the variety of credit account types that you have. There are 3 different types of credit: installment credit, revolving credit, and open credit. Installment credit are types of loans where you borrow a specific amount with fixed payments over a certain amount of time with interest until the loan is paid off. These are things like car loans, student loans, mortgages, and personal loans. Revolving credit lets you borrow money repeatedly up to an approved limit, and you can pay off the full balance or make minimum required payments or higher. Also, if you aren't paying off the entire amount, interest is going to be charged on any balance that you have remaining. Examples of revolving credit includes credit cards, home equity lines of credit or HELOCs, and personal lines of credit. Last is open credit. Your balances are expected to be paid in full at the end of each billing cycle, and these are things like charge cards and utility bills. For example, with utility bills like your electricity, gas, or water, the amount that will be due is based on how much of it that you had used that month. If you decide not to pay the bill, aside from getting your service cut off, it's likely the utility company will end up reporting that late payment to the credit agencies. Next, let's talk about payment history. Your payment history is one of the most important pieces to focus on when trying to maintain or build your credit score. It makes up 35%. That's a big chunk of your total credit score. So it's extremely important to ensure that you make your payments on time and avoid any late payments. Ideally, your goal should be to aim to have 100% on-time payment history, because continually missing payments will impact your payment history and really damage your credit score. And if you're wondering how soon do late payments show up in your credit report, in most cases, when your payment's 30 days or more past its due date, it's reported by the lender to the credit agencies. So if you pay a bill a few days or a week or so after its due date, you may avoid the late item in your credit report, but remember, you will be charged a late fee from the company for your late payment, as well as you risk creating bad habits of not paying your bills on time. So late payments are broken down into 30, 60, 90, and 120 plus days late. Depending on how late your payment is and the standing of your credit score, that'll determine how severe the point drop will be to your credit score. A 30-day late payment to someone with good or higher credit could see a drop of their credit score of over 40 points. Now, if you already have a late payment on your credit report, don't beat yourself up about it. Late payments will remain on your credit report for up to 7 years from the date of the missed payment. Once the late payment drops from your report, your score will increase. So don't worry, this is not a permanent thing. And the best thing you can do is ensure that all your future payments will be on time to continue improving your score and to offset the late payments. Let's get into the length of your credit history. Credit history makes up 15% of your credit score and is defined by the age of your oldest account, as well as the average combined age of all your open credit accounts and credit cards. So to show you an example, one of the factors is the age of your oldest open account. Let's say your oldest card was opened 9 years ago, so this would be your oldest account. The second factor mentioned before is the average age of all credit accounts and cards. So let's imagine you have 3 cards in total. The oldest card you had for 9 years, one for 5 years, and one for 1 year. To calculate the average length of your history, the agencies would take the 3 cards you have and add the length of each one combined, then divide the total length amount by the number of cards you have, which in this case is 3, and that would give you an average credit history age of 5 years. While there isn't a perfect age for your credit history, the optimal age would be 7 years and above. This will have a positive impact on your score. When you have less than 2 years of credit history, this is short in terms of credit history, and it will likely have a negative effect on your score. In between 2 to 7 years will vary, but closer to the upper range, there will be a more positive effect. With that being said, there are some key things you want to know so that you don't unintentionally hurt the age of your credit history. First, resist the need to go and cancel your old credit cards. In a case where you're not using a card anymore, it may seem like a great idea to close it, but in reality, that can make a big change to your credit age. Like we had discussed in an example before with your 3 credit cards that have the ages of 9 years, 5 years, and 1 year, if you decide to close that 9-year-old account, you just remove 9 years from your total credit age. Now your new average credit history is going to be determined from the 5-year-old and 1-year-old cards. That would lower you to 3 years average credit age instead of 5 years. This is all to say you should try and keep your accounts open as long as possible, even if you aren't using your cards, in order not to lose credit history. And for those older cards that aren't being used, it's a good idea to make a purchase on them, even if it's something really small, after a few years, so you don't risk getting them closed due to inactivity. Next point is to avoid opening multiple cards. With all the rewards and sign-up bonuses, it's definitely tempting to open many new cards. But for every new account you open, you will lower the overall average age of your accounts. Of course, if you're just getting started, you want to open new accounts so you can work on building your credit. But opening too many can cause drastic changes. For example, if you have your 3 credit cards, and within the year you add 3 more new credit cards, now your total is going to be divided amongst 6 cards, and now you'll have an average age of 3, which dropped down from 5. Next is new credit. New credit makes up 10% of your overall score. This is new loans or credit lines that you applied for, and when it comes to new credit, there's a few things that you should be aware of that can affect your score. So when you're applying for new credit, whether it's for a mortgage, credit card, auto, personal loan, it doesn't matter. There will be a credit check done, and this is called a hard inquiry. Sometimes you'll hear the word hard pull. This happens when a lender checks your credit report after you've applied for credit. These hard inquiries may lower your score by around 5 points or so, and they will stay on your report for up to 2 years. But by a year, they shouldn't have any effect on your total score. Don't open too many accounts in a short time. Like I mentioned in the last segment of credit history, new accounts will lower your average account age. So even if you've developed your credit for some time, it can still lower your score. Benefits to new credit includes improving your credit mix, since having diversity with different types of credit is beneficial to your credit score. For example, if you have loans and now you'll be adding a credit card to your credit portfolio, that could give you a boost. Opening a new credit card will also increase your available credit. This can increase your credit utilization, which in most cases is good for your credit score. This leads us to our next factor, credit utilization. This makes up the second biggest piece of your credit score at 30%. To keep it simple, this is just a measure of how much credit you're using out of your total available credit limit. For example, between all your credit cards, let's say you have a combined limit of $8,000. So that $8,000 makes up 100% of your available credit limit. Suppose that you decide to use one of your cards to purchase a new laptop that costs $800. Since your limit's $8,000, by buying that new laptop, you're using 10% of your total credit limit. This will give you a utilization rate of 10%. Now, it's recommended that you keep your credit utilization below 30%, but ideally keeping it in the single digits under 10% is going to be much better. A good way to ensure your credit utilization is low is to pay off or pay down your bills. Paying off your balance in full is going to be the best option, since that'll help you keep your utilization rate low. Also, this will allow you to avoid paying any credit card interest, since you won't be carrying over any balance over until the next month. Now, we talked about how closing a credit card could impact your credit history, but it also plays a role in credit utilization. Suppose you rarely or never use one of your credit cards and it has no balance on it. That means that card has a credit utilization of 0. If the combined credit limit of all your cards is $8,000 and you decide to close this old card that makes up $4,000 of your limit, it will lower your available credit. Now, for that same laptop you wanted to purchase for $800, you're now using 20% of your credit rather than just 10. So you can see how this could negatively affect your credit score. But there's a tip to increase the amount of credit you'll have in turn, which will lower your utilization rate. Back to the previous example where you had a combined total credit limit of $8,000, you can go to your credit card providers and request for a credit limit increase. The credit limit increases that you receive on your credit cards will add to your total credit limit. So, going back to the laptop that you decided to buy for $800, with your new credit increases now give you a credit limit of $16,000. Now, that $800 laptop that you bought would only be using 5% of your total credit rather than 10% when you had a total credit limit of $8,000. Doing this can make it even easier to maintain a lower utilization rate given that your spending remains the same. But whatever you do, avoid to use this as a means just to spend more money just because now you have access to more credit. Now that you have an idea what makes up the foundation of your credit score, let's get into a few ways of how you can get started with building your credit. Secured credit card. If you're looking to build your credit from scratch or you don't have much of a credit history, then it may be a good idea to start out with a secured credit card. A secured credit card is different than a traditional credit card because it requires that you put money down as a security deposit in order to receive a line of credit. The amount that you deposit in that account is what becomes your credit limit. For example, if you make a $300 security deposit, then you'll receive a $300 credit limit. The reason for this is because the security deposit that you're making is collateral in case you don't make your payments, and the bank can retrieve what you owe. They're just like any other credit card where you can purchase things, make early payments, pay in full, as well as you can incur interest if you don't pay off your balance. The sole purpose of this card is to use it temporarily to build your credit and to show that you're responsible. So when the time comes and you're finished with this card, you can get approved for a traditional credit card. Credit builder loans are another way to build credit, and it's mainly geared towards those with no credit or poor credit. It's a type of installment loan that has fixed payments, but works differently than a traditional loan. When you apply for a credit builder loan, the amount you choose to borrow is deposited into a secure savings account or a CD, certificate of deposit, which is held by the lender. Then from there, you'll be making monthly fixed payments towards your balance every month. And at the end of the loan term, the lender will return your total balance back to you. So in a way, you're saving money while working on building your credit at the same time. And these loans are usually for small amounts between $300 to $1,000, and they have payment terms that range from 6 months to about 2 years. Now, you may be thinking, what's the point of this loan if I can't purchase anything with it? Well, if you don't have any credit or you're working to restore your credit, credit builder loans help your score through making these on-time payments. Considering that credit history makes up 35% of your FICO score, having this history of on-time payments is what shows lenders that you're responsible enough to be able to take on lines of credit in the future. A third way to build your credit is from alternative credit cards. With alternative credit cards, you can avoid the need to make that security deposit like you would for credit builder loans or a secured credit card. You can still receive a line of credit like you would a traditional credit card, but when it comes to getting approved, it works a bit differently. While the card approval process for traditional credit cards is based on your credit score, alternative cards use other methods. Things like banking related information like your expenses, what your income is, bill payment history, and sometimes other checks like periodically reviewing your account. So ultimately, if you are able to keep your finances stable along with your employment, even if you don't have great credit, you will boost your probabilities of being able to get an alternative card. The last way you can build credit is through being an authorized user on someone else's credit card. An authorized user is someone who's added to the primary credit card owner's account, who's allowed to use their credit card. This means that the authorized user gets an issued card in their name, but that card's still linked to the primary card owner's account. While the primary card holder is the one that's responsible for paying the bill, it's important to understand that if there are any late or missed payments, they will affect the credit of both the primary user and the authorized user. So if you choose to be an authorized user on someone else's credit card, you must be sure that they're responsible when it comes to their credit and managing their payments. Now, of course, it works the other way around as well. If the credit utilization stays low and the balances are being paid off every month, those positive effects are being passed on to the authorized user. Hope this gave you a better understanding of credit. If you enjoyed the video, please hit that thumbs up and subscribe for more videos like this. Thanks for watching, and I'll catch you on the next one.